Welcome back to the deep dive. There are certain forms that arrive in your mailbox or pop up on your screen that just command attention. They look complex, daunting even, promising a dense journey through numbers and codes.
Oh, absolutely.
And for many businesses structured as partnerships, the U.S. Return of Partnership Income, Form 1065, often falls squarely into that category.
It really does. Form 1065 can feel like navigating a dense forest of regulations and, specific line items. But our goal today is to maybe equip you with a map and compass.
Okay.
We're going to embark on a deep dive into the 2024 Form 1065, transforming what might seem like just a compliance exercise into, well, a valuable opportunity for insight.
Exactly. Our mission for this deep dive is to go beyond just what the lines mean. We'll explore the strategic implications of specific sections and, critically, how understanding these intricacies can unlock significant tax efficiencies,
Right.
ultimately saving your partnership both time and, perhaps most importantly, money.
Think of it as finding the strategic levers within the tax code, levers that can truly optimize your partnership's financial position.
Yeah.
And our primary source for this exploration, of course, is the official 2024 instructions for Form 1065, which is, a treasure trove of granular detail if you dig in.
Right, the source itself. So let's unpack this complex form, starting at the very beginning. To truly understand why Form 1065 is filed, we first need to define what the IRS actually considers a partnership.
Okay, fundamentally, the IRS defines a partnership as the relationship between two or more persons joining together to carry on a trade or business.
Okay, two or more people.
Yeah, and this implies a joint contribution, whether it's money, property, labor, or skill, with the shared expectation of participating in the business's profits and losses. It's important to recognize that this definition is broad. It applies regardless of whether a formal, written partnership agreement exists.
Really? So it's not just the paperwork.
No, the IRS looks at the substance of the relationship, what's actually happening, not just its legal form.
So it's not strictly limited to entities formally registered as partnerships or, say, LLCs under state law. It's about the shared intent to operate a business and split the results.
That's exactly right.
Yeah.
It's about the intent and the actions.
What kinds of entities or arrangements does that broad definition sweep in, then?
Well, it's quite encompassing. Beyond the obvious general or limited partnerships, it includes things like syndicates, groups, pools, joint ventures, or really any other unincorporated organization.
Hmm.
The key is that they are actively carrying on a business or financial operation, and they haven't chosen to be classified as something else for tax purposes, like a corporation, trust, or estate. And they're not just a sole proprietorship.
Got it. And what about exclusions? Sometimes knowing what isn't a partnership helps clarify the definition even more.
That's a perceptive point.
Yeah.
The IRS specifically excludes a mere joint undertaking to simply share expenses.
Okay, like splitting costs on equipment?
Exactly. If two individuals jointly own a piece of equipment and just share the maintenance costs, that doesn't automatically create a partnership. Similarly, the mere co-ownership of property that's maintained and then leased or rented out isn't generally a partnership, unless the co-owners also provide significant services to the tenants.
Ah, so the level of service matters.
It really does. If you and a friend simply co-own a rental house and split the rent and taxes, probably not a partnership. But if you're actively managing it, maybe providing concierge services or running it like a short-term vacation rental business with lots of turnover and service.
Then the IRS might see it differently.
Exactly. They might view it as a business operation due to the level of service provided.
That makes perfect sense. And there's a truly compelling alternative for many small business owners, especially married couples, right? Something about saving tax or effort.
Absolutely.
Yeah.
Yes. While a jointly owned and operated unincorporated business by spouses typically falls under the partnership definition, there's a powerful tax-saving alternative, the qualified joint venture, or QJV election.
QJV.
This is a provision specifically designed to reduce administrative burden for married couples running a business together.
This sounds like a potential game changer for many family businesses. Could you elaborate on who qualifies for this QJV election and what the practical benefits are?
Sure. So, if you and your spouse are the only members of a jointly owned and operated business,
Only the two of you.
right, and crucially, both of you materially participate in that business, meaning you're both actively involved in its operations, not just one person doing all the work,
Okay, both involved.
and you file a joint individual return for the tax year, you can elect to be treated as a QJV instead of a partnership.
And the big benefit.
The primary benefit is a significant simplification of your tax compliance. A really big simplification.
So no more filing a separate Form 1065. That's a tangible reduction in paperwork, which often means reduced complexity and costs, right?
Precisely. For any year the QJV election is in effect, you eliminate the need to file Form 1065. And this isn't just about avoiding one form. It's about fundamentally streamlining your tax structure. For a small, jointly owned business, it bypasses the complexities of partnership accounting rules, like maintaining separate capital accounts for each partner, dealing with basis adjustments, and just the added layer of compliance that 1065 requires.
So what do they do instead?
Instead, each spouse can directly report their share of income and expenses on a separate Schedule C, Form 1040, for profit or loss from business, or Schedule F, Form 1040, if it's farming. Much simpler.
And how do they handle self-employment taxes in this scenario? That's always a big one.
Yeah, good question. Each spouse will also file a separate Schedule SE, Form 1040, to calculate and pay their respective self-employment taxes on their share of the business income.
Okay, so the SE tax still gets paid properly.
Right. The business income is effectively split and reported individually, and the self-employment tax burden is still appropriately allocated based on that split. This QJV election is a crucial example of how understanding the tax code can lead to direct savings in compliance costs, potential professional fees, and just hassle for eligible couples.
It really is a fantastic pathway for simplifying compliance for eligible husband and wife businesses. Okay, so for those partnerships that do need to file Form 1065, who exactly falls under that mandate?
The general rule is quite straightforward. Any domestic partnership must file Form 1065. Simple as that.
Okay.
However, this also extends to foreign partnerships. If a foreign partnership generates gross income that is, or is treated as, effectively connected with a U.S. trade or business.
So income tied to the U.S.
Right. Or if it has U.S. source income, it's required to file Form 1065. And this holds true, even if its principal place of business is outside the United States, or even if all its members are foreign persons.
Ah, so the location of the income matters more than the location of the partnership or partners.
Exactly. The IRS is focused on taxing income generated from U.S. activities or U.S. sources, regardless of where the entity is technically domiciled.
So even international entities engaging in certain activities in the U.S. have this filing requirement. Are there any other specialized filers for Form 1065?
Yes, there's a specific requirement for partnerships that operate as, or have a branch that is, a qualified derivatives dealer, or QDD.
QDD. Okay, that sounds specific.
It is. These are typically financial institutions that actively trade derivatives, and their special filing ensures the IRS can accurately track complex financial activities. Yeah. Even if a QDD partnership wouldn't otherwise be required to file Form 1065, they must do so and attach a specific QDD statement detailing certain required information.
So it's an IRS mechanism for transparency in those complex markets.
Pretty much. It ensures visibility into high-volume, complex financial markets.
Let's talk about the practicalities then. The nuts and bolts of filing. What are the general deadlines for Form 1065?
Generally, a domestic partnership must file Form 1065 by the 15th day of the third month following the close of its tax year.
Okay, so for most partnerships using the calendar year.
For the vast majority operating on a calendar year basis, that means the due date is March 15th. However, if March 15th falls on a Saturday, Sunday, or a legal holiday, the due date automatically shifts to the next business day.
Ah, the weekend holiday rule.
Right. So for 2024 calendar year partnerships, for instance, the deadline is actually March 17th, 2025, because the 15th is a Saturday.
Good to know. And with the increasing shift to digital, is electronic filing mandatory for partnerships now? Seems like everything's going digital.
It largely is, yes. The IRS has expanded its electronic filing mandates significantly. Beginning January 1st, 2024, electronic filing is generally required for partnerships if they file 10 or more returns of any type during the tax year.
10 or more of any type, not just the 1065.
Correct. That aggregate count includes not just income tax returns, but also information returns like 1099s, employment tax returns like 941s, and excise tax returns. It all adds up.
Wow.
Furthermore, regardless of that 10 return threshold, partnerships with more than 100 partners must file Form 1065 in all its related schedules electronically.
So big partnerships definitely have to e-file.
Absolutely. This reflects the IRS's push for more efficient processing of high-volume filings.
So for most established partnerships, e-filing is now the default. Are there any limited circumstances where a paper filing might still be an option, maybe for very small ones?
Only in cases of demonstrated hardship. A partnership can request a waiver from the IRS if they can prove that electronic filing would impose an undue hardship. How would they do that? Such a request must be made in writing and sent to the Ogden Submission Processing Center. But it has to be a real hardship. Otherwise, you're looking at e-filing.
Got it. And when does a partnership officially terminate for tax purposes? This seems important for that final return.
Right. A partnership is considered terminated for tax purposes when all its operations are discontinued and no part of any business, financial operation, or venture is continued by any of its partners in a partnership form.
So basically, when it completely stops doing business as a partnership.
Exactly. The partnership's tax year effectively ends on the date of termination, which is the precise moment it winds up its affairs. This is a critical date, especially when dealing with more complex situations like partnership mergers, consolidations, or divisions, which have their own intricate rules regarding termination.
Okay. With that foundational understanding of what a partnership truly is, let's now pivot to the meticulous details that underpin Form 1065 itself. Because getting these initial identification pieces right is often the quiet secret to a smoother tax season and avoiding potential flags down the
Oh,
line.
absolutely.
We're talking about items A through G on page 1.
Yes, these initial items are absolutely foundational for the IRS to correctly identify your partnership. You must accurately enter the partnership's legal name, its physical address, or maybe a CO address if mail is routed through a third party like an accountant or registered agent.
Right.
And critically, the correct Employer Identification Number, or EIN. This is your partnership's unique tax ID, much like a Social Security number for an individual. You have to get that right.
What if a new partnership hasn't received its EIN by the filing deadline? That must happen fairly often with new businesses.
It does, yeah, especially for newly formed entities. You can apply for an EIN online, which is often the fastest way, usually issued immediately upon validation of your information.
Okay.
Or you can apply through mailing or faxing form, SS4. If you haven't received your EIN by the time the return is due, you should write applied for and the date you applied in the EIN space on the form.
Ah, so you indicate it's pending.
Exactly. This informs the IRS that the application is in process, avoiding an immediate red flag for a missing ID number.
Okay. Beyond just the name and number, there's also the principal business activity, or PBA, code. Why is selecting the correct 6-digit code so vital? Seems like just a category.
Well, the PBA code is more than just a statistical classification. It signals to the IRS the primary nature of your business. This can influence how your return is categorized and potentially reviewed against industry benchmarks.
Okay, so it matters for comparison.
Right. You select the code that best describes the activity generating the largest percentage of your total receipts.
Largest percentage of receipts. Got it.
So, for instance, if your partnership designs and sells bespoke furniture, even if you outsource the actual manufacturing, your primary activity is likely furniture manufacturing, if that's where most of your revenue comes from, rather than just retail sales.
Interesting distinction.
Or, for a non-store retailer specializing in prescription drugs, the Pharmacies and Drug Retailers Code is appropriate.
Yeah.
It really helps the IRS understand your operational footprint quickly.
That's a good distinction. It's about the core revenue driver. What about the other identification checkboxes in item G? Things like initial return, final return.
Yeah, item G contains critical checkboxes that communicate the filing status of this specific return. You'll mark whether this is an initial return for a brand new partnership, a final return indicating the partnership has terminated.
Which we just talked about.
Exactly. Or if the partnership has changed its name, or if you're amending a previously filed return. It also flags if you're a special QDD filer. Each of these checkboxes provides essential context to the IRS about this particular filing, ensuring it gets processed correctly.
Okay. Next, let's turn our attention to accounting methods and periods. This might sound like a purely technical detail, but you mentioned it has a significant impact on the bottom line and cash flow.
Indeed it does. An accounting method dictates when and how your partnership recognizes income and expenditures. It's fundamental.
Right.
The chosen method must accurately reflect your income and be consistently applied year after year. Plus, it has to be reconcilable with your internal books and records.
And the two main choices are.
The two primary methods are the cash basis and the accrual basis.
Could you briefly clarify the difference between cash and accrual, and perhaps discuss why a small business might choose one over the other?
Certainly. Under the cash basis, it's pretty intuitive. Income is reported only when cash or its equivalent is actually received, and expenses are deducted only when they are actually paid.
So it follows the cash flow directly.
Exactly. It's generally simpler and preferred by many small businesses for its ease of tracking and for aligning taxable income closely with actual cash moving in and out.
Makes sense. And accrual.
The accrual basis, by contrast, recognizes income when all events have occurred that establish the right to receive it, and the amount can be determined with reasonable accuracy, essentially, when it's earned, regardless of when the cash actually comes in.
Okay. Earned versus received.
Right. And similarly, expenses are deducted when incurred when the obligation arises, not necessarily when paid. Larger businesses, or those with inventory, often use accrual because it provides a more accurate matching of revenues and expenses over a specific period.
And this leads us to a significant tax efficiency opportunity for small businesses related to these accounting methods, doesn't it? Something about capitalization.
It does, and this is a really substantial benefit. For tax years beginning after 2017, a small business taxpayer can elect not to capitalize certain costs under Section 263A.
Section 263A, those are the Uniform Capitalization Rules, or UNICAP.
Exactly, the UNICAP rules. This exception means these qualifying small businesses can immediately deduct costs that larger businesses would otherwise have to capitalize and then depreciate over multiple years.
So instead of spreading those deductions out over time, they get them all up front. How does that directly translate to a tangible tax benefit and improved cash flow? That sounds huge.
It can be huge. Imagine a small manufacturing partnership that typically incurs significant indirect costs related to production, things like factory overhead, storage costs, quality control. Under UNICAP, they normally have to add those costs to the cost of their inventory and only deduct them when the goods are eventually sold.
Delaying the deduction.
But with this small business exception, those costs can be immediately expensed in the year they're incurred. This isn't just a minor tweak, it's a significant boost to a company's immediate cash position.
Because it lowers taxable income right away.
Precisely. Accelerating deductions reduces taxable income sooner, which can lead to lower tax payments in the current year. And that frees up capital for reinvestment, paying down debt, or just handling operational needs. This is particularly impactful for growing businesses that might be reinvesting heavily.
That's a powerful incentive. What exactly defines a small business taxpayer for this beneficial rule? Is there a threshold?
Yes. A small business taxpayer for this purpose is defined as one that is not a tax shelter. That's one condition, and meets the gross receipts test of Section 448.
Okay, the gross receipts test, what's the number?
This means having average annual gross receipts of $30 million or less for the 3 prior tax years.
$30 million. So that actually covers a lot of businesses, not just tiny ones.
Absolutely. A vast number of small and mid-sized partnerships will qualify for this valuable exception. It's a significant relief measure.
Okay. Beyond the codes and accounting methods, what about the crucial operational details that can often lead to headaches if not handled meticulously, like keeping records?
Oh, precision in record keeping is paramount. You absolutely must maintain adequate, organized records to substantiate all income, deductions, and credits reported on Form 1065.
Because if the IRS asks,
If you're ever subject to an IRS inquiry or audit, these records are your first line of defense. They're non-negotiable. Additionally, when assembling the return package itself, you need to adhere to the IRS's specific attachment order.
there's an order.
Yes. Form 1065 itself goes first. Then all the schedules, K1 for the partners, followed by other schedules alphabetically, like Schedule D, Schedule F, and then other forms numerically, like Form 4562 for depreciation, Form 8990 for interest limitation, if applicable.
Alphabetical, then numerical.
Okay. This structured approach helps ensure smooth processing on their end.
And a crucial point about how the forms themselves are filled out, avoiding those frustrating see attached notes, right?
Exactly. That's a big one. It's essential to complete every applicable entry space on the forms themselves. Do not simply write "see attached" unless a specific instruction explicitly allows it for that line.
Why is that such a big deal?
The IRS can actually assess penalties for incomplete returns. If you truly need more space than what's provided on the form line, you should attach separate sheets that are the same size and format as the official form, but always ensure the totals are clearly transferred and shown on the printed forms themselves.
Okay, transfer the totals back.
Yes. And critically, your partnership's name and EIN must appear on every single supporting statement or attachment. Every single one.
Wow.
This attention to detail isn't just about neatness. It's vital for efficient and accurate processing by the IRS. Missing info can cause delays or errors.
Good advice. Who specifically is authorized to sign Form 1065? Can any partner sign it?
No, not just any partner. The return must be signed by a general partner, or, in the case of a limited liability company, LLC, taxed as a partnership, by an LLC member manager.
So, someone with specific authority.
Right. It must be an individual with the specific authority to bind the partnership in tax matters.
And what about allowing a paid preparer to speak with the IRS? That seems like it could significantly streamline communication if there are questions or issues later on.
It can be incredibly helpful, yes. There's a section in the signature area of the return. If you want to authorize your paid preparer to discuss your 2024 Form 1065, specifically with the IRS, you simply check Yes in that box.
And what does that authorization allow them to do?
It grants them limited authority. They can answer specific questions about how the return was prepared, provide missing information if needed, check on the processing status, and respond to certain math error notices from the IRS.
So it's helpful for routine follow-up.
Very practical, yes. It's a very specific authorization, though. It doesn't give them full power of attorney to represent the partnership more broadly in, say, an audit negotiation.
Okay, for broader representation, you'd need something else.
For broader representation, a separate Form 2848, Power of Attorney and Declaration of Representative, would be required.
Got it. That wraps up our second segment on the basics. Let's now dive into segment 3. Unpacking partnership income and deductions and identifying those strategies for tax-efficient reporting. This is where we start uncovering some of the most impactful opportunities for reducing your partnership's taxable income.
Indeed. And a foundational understanding here, right off the bat, is the distinction the form makes between trade or business income and deductions and other income.
Okay, how does that work on the form?
The first page of Form 1065, lines 1 through 21, is designed exclusively for reporting income and deductions generated from the partnership's primary trade or business activities.
Exclusively trade or business. So activities like rental income or investment income, maybe interest or dividends, they don't appear on page 1.
Precisely. Rental activity income or loss, and portfolio income like interest, dividends, royalties not related to the business, capital gains are not reported on page 1.
Where do they go then?
Instead, they flow through separate schedules, specifically Schedule K, which summarizes the totals for all partners, and then they are detailed for each partner on their individual Schedule K1.
And why is that distinction so critical?
It's critical because it dictates how these different types of income are ultimately treated at the partner level, especially concerning things like the passive activity rules, net investment income tax, and QBI deductions. Misclassifying income here can lead to incorrect tax outcomes for the partners down the line.
Okay, makes sense. Let's start with the income items on page 1 then, lines 1 through 8.
Right. The initial lines capture the partnership's core operational income. This typically begins with line 1A, gross receipts or sales, your total revenue from primary business activities.
The top line.
Exactly. From this, you subtract returns and allowances on 1B, and then the cost of goods sold on line 3, which is a detailed calculation handled on a separate form, Form 1125A.
Form 1125A for COG checks. What goes into that?
That form accounts for things like beginning inventory, purchases, direct labor costs, materials and supplies, and other costs directly related to producing or acquiring the goods you sell. Subtracting COG checks from net receipts gives you your gross profit on line 4.
Okay.
Then line 8 is for other income or loss. This is where you report income not directly from your main sales activity, for example, interest earned on business bank accounts, maybe dividends if they're related to the business somehow, royalties unrelated to the core business, or perhaps the net gain or loss from the sale of business property reported on Form 4797.
Got it. All right, now for the deductions, lines 9 through 21. This is where we really start to pinpoint opportunities for reducing taxable income. What's first on the list of common deductions?
First up on line 9 are salaries and wages. These are deductible for amounts paid to employees. It's important to exclude amounts you might have already capitalized as part of an asset's cost, or elective contributions to employee retirement plans, because those are reported elsewhere.
Okay, just the direct wages here. And then one of the most critical lines specifically for partners, guaranteed payments to partners on line 10. This is a big one for tax efficiency, and understanding its mechanics is key, right?
It absolutely is. Guaranteed payments are specific payments or credits made to partners for services they render to the partnership or for the use of capital they've provided.
Okay.
But the key is that these payments are determined without regard to the partnership's income. So it's like a fixed salary or a set interest payment, not a share of profits.
Not dependent on profit.
And the tax benefit. The critical tax benefit here is that these payments are deductible by the partnership on line 10. This effectively reduces the partnership's ordinary business income on line 22.
Lowering the partnership's income.
Which means less taxable income is then passed through to the partners on their K1. So less income subject to tax at the partner level overall.
So the partnership gets the deduction. Are there any specific inclusions that are important to note regarding guaranteed payments, things people often get wrong?
Yes, this is a very common point of confusion. Amounts paid during the tax year for health insurance for a partner, their spouse, dependents, or their children under age 27 are specifically included here on line 10 as guaranteed payments.
Health insurance for partners goes on line 10, not with other employee benefits.
Correct. This is distinct because these amounts are not treated as employee benefit program expenses down on line 19, even though it feels like a benefit. They are considered guaranteed payments to the partner for services rendered.
And the tax treatment follows that.
Yes. They are deductible by the partnership on line 10. The partner then includes them in their gross income, but the partner may then be able to deduct those same premiums as self-employed health insurance on their individual Form 1040, potentially offsetting the income.
Ah, that's a vital distinction for proper reporting and for the partner's own return. And what's the implication for the partners themselves, especially concerning passive activity income? Does this count as passive?
Generally, no. Guaranteed payments made to a partner for personal services they performed or for the use of their capital are not considered passive activity income for that partner.
Why is that important?
This is a crucial point for avoiding passive loss limitations at the partner level. If a partner has passive losses from other enhancements, say rental properties, guaranteed payments they receive for active services to the partnership are non-passive income. Those passive losses generally can't offset this non-passive guaranteed payment income, but it also means the guaranteed payment income itself isn't subject to those limitations. It provides clarity and affects how losses can be used.
Okay, that's a key planning point. Let's move on to repairs and maintenance on line 11.
Right. These expenses are deductible on line 11, but only to the extent they are ordinary and necessary and directly relate to a trade or business activity, routine upkeep, fixing things.
Standard stuff. Is there any tax efficiency angle here?
Well, there's an election. The partnership may elect to capitalize certain repair and maintenance costs, consistent with how it treats them on its books and records.
Why would they choose to capitalize instead of deducting immediately?
While it doesn't result in an immediate deduction, capitalizing might be part of a strategic asset management approach. It means the cost is added to the basis of the property and recovered over time through depreciation. Sometimes, aligning tax treatment with book treatment or managing the timing of deductions over the long term makes this election beneficial depending on the partnership's overall financial planning.
Interesting choice. What about bad debts on line 12?
Worthless debts incurred in a trade or business activity are deductible on line 12. If a customer simply doesn't pay and you determine the debt is uncollectible, it's important to distinguish these from non-business bad debts, which partners might have personally. Those are generally treated as short-term capital losses on Form 8949 and subject to capital loss limitations. This line is only for business bad debts.
Got it. Next, interest expense on line 13. This area can get particularly complex with allocation rules and limitations you mentioned.
It certainly can. First, generally, interest expense must be allocated based on how the debt proceeds are used. These are known as the tracing rules under Temp Reg 1.163-8T. You trace where the borrowed money went to determine if the interest is related to the business, investment, personal use, etc.
Okay, follow the money.
Right. More significantly, for tax years beginning after 2017, there is a business interest expense, or BIE, limitation under Section 163J. This rule generally limits the amount of BIE a taxpayer can deduct each year.
Limits the interest deduction to what?
Generally, the limit is 30% of the taxpayer's adjusted taxable income, plus business interest income, plus floor plan financing interest for vehicle dealers.
A 30% limitation sounds like it could significantly restrict deductions for many businesses, especially those with a lot of debt. Is there a tax-saving exemption for this BIE limitation?
There is, yes, and it's a crucial tax-saving exemption for a significant portion of the business landscape. A small business taxpayer is not subject to the BIE limitation at all.
Not subject at all.
Correct. And they are not required to file Form 8990, which is the complex form used to calculate the limitation and carry forwards. This means they can generally fully deduct their business interest expenses without any cap based on income.
That's huge. And what's the definition of a small business taxpayer for this BIE exemption? Is it the same as for the UNICAP exception we talked about?
It is indeed the same definition. A taxpayer that isn't classified as a tax shelter and meets the gross receipts test of Section 448C.
Which was?
Having average annual gross receipts of $30 million or less for the 3 prior tax years.
$30 million again.
Yes. This provides really significant relief for many smaller partnerships, allowing them to fully deduct their legitimate business interest expenses without burdensome calculations or artificial limitations. For a growing business relying on debt financing, this can translate into substantial tax savings and a much clearer picture of their actual profitability. It simplifies things dramatically.
That's a huge win for maintaining healthy cash flow and reducing complexity. What other deductions should we highlight on page 1?
Okay, quickly, we have depreciation on line 14. This is where you deduct the cost of business assets over their useful life using methods like MCRS. You'd exclude any amounts already capitalized or claimed elsewhere, like the Section 179 expense deduction, which often gets reported separately to partners.
Okay.
Then there are contributions to retirement plans, like 401k or SEPs for employees on line 18, and employee benefit programs, like health insurance for non-partner employees on line 19.
And just to reiterate that key distinction we discussed.
Yes, it's worth repeating. Partner health insurance payments go on line 10 as guaranteed payments, not here on line 19 with employee benefits. Big difference in treatment.
Got it. Is there anything specific for energy efficiency that partnerships should be aware of as a deduction?
Yes, line 20 includes the energy-efficient commercial building deduction under Section 179D. This is a direct deduction for qualifying expenditures made to make commercial buildings more energy efficient. It requires completing and attaching Form 7205.
So a specific incentive there.
Exactly. It's designed to encourage investments in green infrastructure, offering a tangible tax break for qualifying projects.
And finally, that broad category other deductions on line 21, what typically falls into that bucket? Seems like a catch-all.
It is a catch-all for all other allowable, ordinary, and necessary trade or business deductions not covered on the specific lines above. Common examples include travel expenses, certain meal expenses, professional fees, office supplies, utilities, business insurance. Lots of things can land here.
Okay. And you mentioned travel and meals. Those have rules, right?
Very specific rules. It's important to remember that travel expenses for someone accompanying a partner or employee, like a spouse, are generally not deductible unless that individual is also an employee of the partnership, and their travel is for a bona fide business purpose. You can't just deduct a vacation add-on.
Makes sense. And the rules for meals have seen significant changes and can be quite nuanced, correct? They keep changing.
They have indeed. Generally, the partnership can only deduct 50% of non-entertainment business meal expenses.
Only 50%.
Right. And meals considered entertainment-related are generally disallowed altogether now, with very few narrow exceptions. This area requires meticulous record-keeping who, what, when, where, why, and a clear understanding of the current rules to ensure you're maximizing what you can legitimately deduct without running afoul of regulations. Gifts also have their own set of specific rules and dollar limitations per recipient per year.
Lots of details there. Okay, speaking of complex rules, let's circle back quickly to the Uniform Capitalization, or UNICAP, rules under Section 263A. We mentioned the small business taxpayer exception, which is huge, but what do these rules generally entail for businesses that don't qualify for the exception?
Right. For businesses that are subject to UNICAP, generally larger businesses, or those that don't meet the gross receipts, these rules require them to capitalize, rather than immediately deduct, certain direct and indirect costs related to production or resale activities.
Capitalize means add to the cost of an asset.
Essentially, yes. For example, if you're a manufacturer, costs like factory overhead, depreciation on production equipment, insurance on the factory, quality control, purchasing department expenses, these might need to be added to the cost of your inventory shown on the balance sheet.
And you only get the deduction when?
You only get the deduction for those capitalized costs when the inventory is actually sold, as part of the cost of goods sold calculation. So it delays the deduction compared to expensing it immediately.
Which highlights again how valuable that small business taxpayer exception is.
Absolutely. Being able to elect not to capitalize costs under Section 263A, if you qualify based on the $30 million gross receipts test, can significantly accelerate your deductions and directly improve your cash flow as you get to expense those costs immediately. It avoids a lot of complex allocation calculations, too.
So for many small businesses, they don't have to worry about delaying these deductions under UNICAP. Are there any other final special considerations on deductions that partnerships should be aware of before we move on?
Yes. One more important one to be mindful of are the rules for transactions between related taxpayers under Section 267.
Related taxpayers, like a partnership and a partner, or entities controlled by the same people.
Exactly. Generally, an accrual basis partnership cannot deduct business expenses or interest owed to a related cash basis party until the payment is actually made and therefore includable in the related party's income.
Why is that rule there?
It's an anti-abuse rule. It's designed to prevent related parties from manipulating the timing of deductions and income. For example, the accrual partnership couldn't deduct an expense in year one that it owes to a cash basis partner if it doesn't actually pay the partner until year two. The deduction is deferred until the income is recognized by the recipient. It ensures a level playing field and prevents artificial tax deferrals between related entities or individuals.
Okay, good to know. That brings us to segment 4, which is absolutely crucial for the partners themselves. Decoding schedules K and K1, the partner's tax blueprint. Why are these schedules so central to the whole partnership taxation system?
They are the very core of the pass-through concept. The partnership itself, unlike a C corporation, generally doesn't pay federal income tax.
Right, it's a pass-through entity.
Exactly. This means the income, deductions, credits, gains, losses, and other tax items generated by the partnership pass through directly to the partners.
Whether or not they actually got the cash.
That's a key point. Yes, whether or not that income is actually distributed to them in cash. The partners are then individually liable for tax on their respective shares of the partnership's items, based on the partnership agreement.
And schedules K and K1 are how this information gets reported.
Precisely. Schedule K is essentially a summary schedule on the Form 1065 itself. It aggregates the totals of all partners' shares of these various income, deduction, credit, and other items.
Like a master list for the partnership.
Exactly. Then, Schedule K1 is a separate form prepared for each individual partner. It breaks down that partnership total from Schedule K and shows each specific partner's separate share of each of those items.
So Schedule K is the partnership's summary, and K1 is the personalized report card for each partner. And I assume partners absolutely need their K1 to file their own individual tax returns.
Absolutely critical. It's essential for partners to receive their K1 on time, generally by the partnership's filing deadline, including extensions, and it needs to be accurately filled out. Without it, they simply cannot correctly file their individual income tax returns.
Form 1040 leads to problems.
Oh yeah, delays, errors, potentially penalties for late filing or incorrect reporting on their personal return. The K1 is their essential guide to properly incorporating all the partnership activity into their personal tax situation.
Let's delve into some general information on K1 Parts 1 and 2 first, the identifying stuff.
Right. Part I and II contain the foundational identification information. Part I has the partnership's information, its EIN, name, address. Part II has the partner's information, their identifying number, SSN, ITN, or EIN if they're an entity, name, and address.
Seems straightforward.
Mostly. But there are specific rules for different types of partners. For example, if the partner is an IRA, you use the IRA's EA. If the partner is a disregarded entity, DE, like a single-member LLC owned by an individual, you report the DE's name and the owner's identifying number, like the individual's SSN. Ensuring this basic info is accurate is the very first step in proper K1 reporting.
Good point about DEs. Then we get to item J on the K1, partner's profit, loss, and capital percentages. This provides a snapshot of each partner's ownership stake and how their investment changes over time, right?
Yes. Item J is highly significant. It details the partner's percentage shares of profit, loss, and, importantly, capital at both the beginning and the end of the tax year. These percentages should generally reflect the terms outlined in the partnership agreement.
And the capital part is key.
Yes, the capital line, specifically item L on recent K1 forms, is particularly important as it represents the partner's capital account, which must now generally be reported using the tax basis method.
Tax basis method, what does that track?
This account meticulously tracks their contributions to the partnership, cash and property basis, their allocated share of the current year's net income or loss, any other increases like tax-exempt income or decreases like non-deductible expenses, and any withdrawals or distributions they receive during the year. It shows their equity in the partnership on a tax accounting basis.
Okay. And you mentioned earlier there's a specific tax insight related to Section 743B basis adjustments that doesn't directly show up in this capital account calculation, but is critical for a partner's overall tax picture, correct?
You've hit on a critical nuance that many overlook, yes. Section 743B basis adjustments. Those special adjustments that can happen when a partnership interest is sold or inherited if a Section 744 election is in effect are not taken into account when calculating a partner's capital account under the tax basis method shown in item L.
So the capital account doesn't reflect that personalized adjustment.
Correct. However, these 743B adjustments do profoundly affect a partner's overall adjusted tax basis in their partnership interest, which is a separate calculation that includes their share of partnership liabilities and critically impact their future gains, losses, and their share of depreciation deductions related to the adjusted assets.
Could you provide a quick example again to illustrate how a Section 743B adjustment provides a direct tax benefit? Make it concrete.
Certainly. Let's use Sarah again. She buys a 25% interest in an existing partnership for $100,000. Let's say her share of the partnership's existing tax basis in its assets, the inside basis, is only $70,000 based on the partnership's books. If the partnership has a Section 754 election in effect,
Which we'll talk more about.
yes, then a Section 743B adjustment occurs specifically for Sarah. This creates a personalized positive basis adjustment of $30,000, $100,000 purchase price, minus $70,000 inside basis share, just for her.
Only affects her.
Right. This $30,000 step-up means Sarah can potentially claim an additional $30,000 in depreciation deductions over the assets' remaining lives, allocated just to her K-1. Or, if those assets are sold later, it reduces her share of the taxable gain by $30,000 compared to the other partners. This is a direct, substantial tax benefit specific to her, effectively giving her a personalized cost basis for her share of the partnership's assets that aligns with her actual investment.
That's a really powerful tool for new partners or those who inherit an interest. Okay, let's move to item K on the K1. Partners' share of liabilities and its impact on the crucial at-risk rules. Why are liabilities so important on the K1?
Item K is essential because a partner's share of partnership liabilities generally increases their outside basis in their partnership interest. Basis is crucial because it limits the amount of losses a partner can deduct and affects gain or loss when they sell their interest or receive certain distributions.
More basis means potentially more deductible losses.
Generally, yes. Item K distinguishes between recourse liabilities where a partner or a related person bears the economic risk of loss if the partnership can't pay.
Like they personally guaranteed it.
Exactly. And non-recourse liabilities where no partner is personally liable, and the lender's only recourse is the property securing the debt, like a typical mortgage on a building secured only by the building itself.
Okay, recourse versus non-recourse. And you mentioned a specific type.
Yes, a specific and very important type of non-recourse liability is qualified non-recourse financing, or Q&F.
Qualified non-recourse financing. What exactly is Q&F and why does it have such a significant tax implication, especially for the at-risk rules?
Q&F typically refers to financing for which no one is personally liable, that is borrowed for use in an activity involving holding real property, and is loaned or guaranteed by a federal, state, or local government, or borrowed from a qualified person like a bank, insurance company, or pension trust, not usually the seller of the property or a related party.
Okay, specific criteria and the tax implication.
The crucial tax implication is that Q&F is specifically treated as an amount at risk for partners under Section 465. This is vital.
Why? What do the at-risk rules do?
The at-risk rules generally limit a partner's deductible losses from an activity to the amount they are considered at risk, essentially the amount they personally stand to lose economically in the venture, like their cash contributions, property contributions, and recourse debt. Non-recourse debt usually doesn't count towards the at-risk amount.
But Q&F is an exception.
Exactly. By treating Q&F as an amount at risk, it can increase the amount of losses a partner can deduct from activities involving real property, even though it's non-recourse debt. This is a direct and significant tax benefit for partners, particularly in real estate ventures, which often rely heavily on this type of financing. It allows potentially larger loss deductions sooner.
So understanding how liabilities are classified, especially Q&F, can directly impact how much loss a partner can actually claim each year. This brings us to a really fascinating area. Partnership elections that the partnership makes, but that have a direct and often profound impact on the partner's individual taxes.
You're absolutely right. These elections can shape the entire tax landscape for the partnership and its partners. The entity classification election, made using Form 8832, is a prime example we touched on earlier.
The check-the-box election.
Right, the check-the-box regulations. This allows an eligible business entity, like an LLC with at least 2 members, to choose how it wants to be classified for federal income tax purposes, either as a partnership, the default for domestic multi-member LLCs, or as an association taxable as a corporation.
And that choice is fundamental.
It's a foundational decision that profoundly impacts how the business and its owners are taxed from direct pass-through taxation as a partnership to potential double taxation. corporate-level tax, then tax on shareholder dividends, if classified as a corporation.
It's a strategic choice, often made at formation, that ripples through all future tax years.
That's a really fundamental decision. And then there's the Section 754 election, which we just discussed in the context of Sarah's 743B adjustment. It sounds highly technical, but you emphasized it provides significant tax benefits, especially when partnership interests change hands. It is indeed a major one for tax benefits, especially in dynamic partnerships where interests are bought, sold, or passed down. If a Section 754 election is properly made by the partnership, it's made on the partnership return and generally stays in effect, and then there's a sale or exchange of a partnership interest or a transfer upon the death of a partner, that Section 743B adjustment occurs. As we discussed, this adjustment affects only the transfer partner's basis in the partnership property.
The buyer or inheritor.
Right. It provides them with that personalized basis for calculating their share of future depreciation or gain loss, potentially leading to a significant step up in basis that allows for higher depreciation deductions or a reduction in future taxable gain when the partnership sells those assets. This can result in truly significant tax savings for the new partner, aligning their tax basis with their actual economic investment or the fair market value at death.
So it avoids penalizing the new partner for built-in gains that accrued before they joined.
Exactly. There are also similar Sections 734B adjustments that can occur if the 754 election is in effect upon certain types of partnership distributions, which adjust the basis of the partnership's remaining assets. Both aim to reduce distortions between inside and outside basis.
That's a highly specialized but powerful tax planning tool that directly benefits partners. Are there other important elections the partnership might make?
Yes. Another significant one relates to the audit rules. Eligible partnerships can elect out of the centralized partnership audit regime, sometimes called BBA, after the Bipartisan Budget Act that created it.
Centralized audit regime, what's that?
This regime, which generally applies to partnership tax years beginning after 2017, was primarily designed to streamline IRS audits of large, complex partnerships. Under BBA, the audit adjustments and often the collection of tax happen at the partnership level, rather than the IRS having to individually audit potentially hundreds or thousands of partners.
Okay. Efficient for the IRS maybe, but complex for the partnership.
It can be, yes. However, generally, partnerships with 100 or fewer qualifying partners, partnerships, corporations, nominees, and estates trusts other than grantor trusts or generally not qualifying partners, can make an annual election out of this BBA regime on a timely filed Form 1065.
And what happens if they elect out?
Electing out reverts them back to the pre-2018 audit rules, known as the TEFRA rules, or just regular deficiency procedures for very small partnerships. Under these older rules, adjustments are generally made and assessed at the partner level. This can be simpler and more familiar for smaller partnerships to navigate if they face an audit. It avoids the potential complexities and partnership-level payment obligations of the centralized BBA regime.
So a choice between partnership-level or partner-level audit adjustments. And what about the election to avoid self-charged interest rules? This sounds like it could prevent some unexpected passive income issues when partners lend money to the partnership.
This election, found under Regulation Section 1.4697G, gets quite technical, but is relevant in situations where a partner lends money to the partnership, or the partnership lends money to a partner, and the partner has both interest income and interest expense related to that transaction and the partnership's activities.
Okay, self-dealing interest.
Right. Without this election, the default self-charged interest rules can recharacterize some or all of the partner's interest income from the loan, which might otherwise be portfolio or passive income, as non-passive income. This allows it to offset the partner's share of the partnership's interest expense deduction, which might otherwise be passive. Usually this works out favorably for the partner by freeing up passive losses.
So the default rule is often helpful. Why elect out?
Well, the partnership can elect out of applying this self-charged recharacterization rule. This provides flexibility. Maybe the partner wants the interest income to remain portfolio or passive for some other planning reason, or perhaps the calculation is complex. The optimal choice depends heavily on the partner's overall passive income and loss situation from all sources. It's a complex area, but having the election provides an important planning lever.
Interesting. So the partnership makes these significant elections, but are there any elections that the individual partners make on their own returns, but which are directly driven by information flowing from the partnership K1?
Absolutely. There are several elections made at the partner level. One notable example is the election under Section 59E.
Section 59E, what's that for?
This allows an individual partner to elect to deduct certain qualified expenditures passed through from the partnership. Things like intangible drilling costs, IDCs, mining exploration expenditures, or research and experimental R&D expenditures ratably over 10 years, instead of taking the potentially large immediate deduction allowed under normal rules.
Why would a partner choose to spread out a deduction over 10 years?
It offers significant flexibility in tax planning for the individual partner. Maybe they are in a low tax bracket in the current year, or subject to the alternative minimum tax, AMT, which can be triggered by large deductions like IDCs. Spreading the deduction over 10 years allows them to smooth out their income and potentially get more tax benefit from the deduction in future higher income years or avoid negative AMT consequences. It lets them strategically choose when to recognize these deductions to best suit their individual tax situation.
So it's about timing and optimizing the value of the deduction for their specific circumstances.
Precisely. Other partner-level elections driven by K-1 information include elections under Section 108 regarding income from discharge of indebtedness passed through from the partnership, or Section 617 related to the deduction and potential recapture of mining exploration expenditures.
It's fascinating how the partnership structure provides so many layers of options for both the entity and the individual partners for tax planning and optimization. That leads us right into segment 5, navigating activity classifications and crucial deductions with a focus on maximizing your qualified business income. Let's start with that fundamental distinction between passive and non-passive activities again, as it applies to partners.
This distinction is paramount for partners because, as we touched on, it directly impacts the deductibility of losses flowing through from the partnership. Generally, if a partner doesn't materially participate in a partnership trade or business activity,
Materially participate meaning.
meaning their involvement isn't regular, continuous, and substantial based on specific tests in the regulations, like spending more than 500 hours or being the primary person involved, then that activity is considered a passive activity for that specific partner. Consequently, any net losses generated from that passive activity may be limited. Generally, passive losses can only be deducted against passive income from other sources. They can't typically offset non-passive income like wages, salaries, or portfolio income.
So it's really about whether the partner is truly involved hands-on in the operations, not just a passive investor providing capital.
Precisely. It's a highly facts and circumstances driven determination, and it's made partner by partner. One partner might materially participate, while another in the same partnership might not.
And the partnership needs to provide the info for this.
Yes. While the partnership's overall ordinary business income or loss is summarized on page 1 of Form 1065, the specific income and deductions from each separate trade or business activity must be reported on attached statements to Form 1065. This detailed breakdown, showing the results for each activity, is then passed through on attached statements to each partner schedule K-1.
So the K-1 gives the partner the building blocks.
Exactly. It provides the necessary detailed information for each partner to determine their individual material participation level for each activity and apply the passive activity loss, PL rules, correctly on their own return.
What about rental activities? Are they always treated as passive, or are there nuances there too?
Generally, rental activities are considered passive by default under the law, regardless of the partner's participation level. However, there are several important exceptions that can reclassify a rental activity as non-passive, potentially unlocking greater deduction potential for losses.
Okay, what are some key exceptions?
For instance, if the average period of customer use for the rental property is 7 days or less, like a typical short-term vacation rental.
Like Airbnb's often.
Exactly. Or if the average use is 30 days or less, and the partnership provides significant personal services along with the rental. Other exceptions include providing extraordinary personal services, like maybe in a healthcare facility, or if the rental activity is incidental to a non-rental activity, such as a developer holding completed condos for rent briefly before selling them. If an exception applies, the activity isn't automatically passive, and then the material participation rules would determine if it's passive or non-passive for a specific partner.
So if you're running what looks more like an active service business, even if it involves renting property, it might not be automatically passive. Is there a specific tax benefit for partners involved in rental real estate activities, even if they are passive?
Yes, there's a significant potential benefit, a special allowance, for partners who actively participate in a rental real estate activity.
Active participation, is that different from material participation?
It is. Active participation is a lower standard. It doesn't require the same level of regular, continuous involvement. It generally requires the partner to be involved in significant management decisions in a bona fide sense. Things like approving new tenants, deciding on rental terms, approving capital expenditures or repairs. You can even hire agents or managers and still be considered active.
Okay, so making key decisions.
Yeah.
And the benefit.
If a partner actively participates, they may be able to deduct up to $25,000 of losses from that rental real estate activity against their non-passive income, like wages.
$25,000 offset against wages. That's useful.
Very useful. However, this $25,000 allowance is subject to income phase-outs. It starts to phase out once the partner's modified adjusted gross income, MAGI, exceeds $100,000 and disappears completely once MAGI reaches $150,000. But for partners within those income ranges, understanding how to qualify for and properly report these active rental losses is a key strategy for maximizing that $25,000 deduction, which can translate into substantial tax savings.
Good to know about that phase out. This raises an important question for partnerships with multiple business lines or properties. Can those activities be grouped together for tax purposes, maybe to help with these passive loss rules?
Yes, absolutely. This is where strategic tax planning regarding activity definition truly shines. The regulations allow a taxpayer, which includes partners receiving K-1s, to treat one or more trade or business activities, or even rental activities, as a single activity if they constitute an appropriate economic unit for the purpose of measuring gain or loss under the passive activity rules.
Grouping activities into one unit.
Right. This election to group activities is made by the taxpayer, the partner, in this case not the partnership, though the partnership must provide the information needed to potentially make the grouping. Once a grouping is made, it's generally binding for future years, unless circumstances materially change.
And what's the benefit of strategically grouping activities like that? It sounds like it could be powerful for loss utilization.
It can be a significant advantage, yes. Grouping allows partners to combine the income and losses from multiple activities into one single passive activity calculation. For instance, if you have one activity within the group that generates a passive loss, and another activity in the same group that generates passive income.
They net against each other.
Exactly. Grouping them allows the loss from one to directly offset the income from the other within that single grouped activity. This can help partners overcome the passive activity loss limitations more easily because you only look at the net result of the entire group. It means more losses might become deductible currently against the passive income within the group, leading to greater overall deductions and potentially a lower tax bill.
What factors determine if grouping is appropriate?
The regulations list factors to consider, such as similarities and differences in the types of trades or businesses, the extent of common control and ownership, geographical location, and interdependencies between the activities, like shared customers, suppliers, or operational functions. It has to make sense as an economic unit. It provides flexibility to manage the passive loss rules more effectively based on the business reality.
I see. So it's about presenting a realistic, unified economic front to the IRS to maximize deductions within the passive loss framework. What about income recharacterization? Partners need to be aware of rules that can flip income they might think is passive into non-passive, right?
Precisely. You need to be aware of several rules that can recharacterize passive income as non-passive. This prevents taxpayers from generating passive income solely to absorb otherwise unusable passive losses.
What are some examples?
One common one is income from significant participation in passive activities, or SPAs. If a partner participates in an activity for more than 100 hours during the year, but doesn't meet any of the tests for material participation, so it's passive, the net income from that activity can be recharacterized as non-passive. The losses, however, remain passive.
That seems tough. Income becomes non-passive, losses stay passive.
Exactly. Another example involves renting property that is incidental to development activities, or renting property where less than 30% of the unadjusted basis is depreciable, like renting raw land. Net income for these types of rentals can also be treated as non-passive. Understanding these rules is crucial to avoid unpleasant surprises where income you assumed was passive and could offset passive losses is instead recharacterized, potentially leaving those passive losses suspended and unusable in the current year.
Okay, lots to track there. All right, now for what many partners, especially those in profitable operating businesses, are keenly interested in, the qualified business income, or QBI, deduction under Section 199A. This is a very significant tax-saving provision for eligible partners, isn't it?
It absolutely is. Introduced as part of the 2017 Tax Cuts and Jobs Act, the QBI deduction is a potentially substantial benefit. It allows eligible taxpayers, primarily individuals, but also some trusts and estates, to deduct up to 20% of their qualified business income earned from a qualified trade or business conducted directly or passed through from a partnership, S corp, or sole proprietorship.
A 20% deduction on business income? That sounds great.
It can be, yes. This deduction is determined at the partner level, meaning each partner calculates it individually on their Form 1040 based on the detailed QBI information the partnership provides on their Schedule K-1. It's a deduction from adjusted gross income, meaning it directly reduces taxable income, which can substantially lower a partner's overall effective tax rate and final tax liability.
So what exactly is qualified business income for these purposes? What counts?
QBI generally includes the net amount of qualified items of income, gain, deduction, and loss from the partnership's trades or businesses that are effectively connected with conducting a trade or business within the United States.
Okay, so U.S. business income. Examples.
This typically encompasses items like the partner's share of the partnership's ordinary business income or loss from Form 1065, page 1, certain Section 1231 gains or losses from the sale of business property, Section 179 deductions taken at the partnership level that reduce business income, and even interest income earned on working capital or from debt finance distributions related to the business. Rental or royalty income can also be QBI if the rental activity rises to the level of a Section 162 trade or business, which has its own set of criteria or safe harbors.
Interesting. And what are some of the key exclusions from QBI that partners need to be mindful of? What doesn't count?
Important exclusions from QBI include items that aren't considered trade or business income, things like capital gains and losses, dividends, most interest income, unless it's properly lockable to the trade or business like we just discussed, any wage income received by a partner acting as an employee, which is rare in partnerships, guaranteed payments received for services, and certain commodities or foreign currency gains or losses. The key distinction is that QBI must generally come from an active operating trade or business, not typically from passive investment-type income or payments received for services that resemble wages.
And then there's the complicating factor of specified service trades or businesses or SSTBs. These can significantly limit or even eliminate the QBI deduction for higher income taxpayers, right?
Yes, that's a critical limitation. SSTPs are certain types of service businesses where the principal asset is considered the reputation or skill of its employees or owners. Income from an SSTB is generally excluded from the definition of a qualified trade or business for taxpayers whose taxable income exceeds certain thresholds, which are indexed for inflation annually.
So for higher income partners, income from an SSTB might not generate any QBI deduction at all.
Correct. Once your taxable income exceeds the upper threshold, $481,900 for married filing jointly in 2024, $240,950 for others. QBI from an SSTB is completely disallowed. There's a phase-out range below those thresholds where a partial deduction might be allowed.
What kinds of businesses are considered SSTBs?
The law lists specific fields: health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, and brokerage services. It also includes services consisting of investing and investment management, trading, or dealing in securities, partnership interests, or commodities. And there's a catch-all for any business where the principal asset is the reputation or skill of one or more of its employees or owners, like receiving income for endorsements or appearances.
That's a broad list. So the partnership has to tell partners if it's an SSTB.
Absolutely. Partnerships have a crucial role here. They must identify on the Schedule K-1 whether their trades or businesses are SSTBs when reporting the QBI information to partners. This is essential for partners to correctly apply the SSTB limitation based on their individual income level.
That distinction is critical for partners planning their individual taxes. But you mentioned earlier there's a strategic move involving the aggregation of trades or businesses that can potentially help partners maximize their QBI deduction, maybe even if some limitations apply.
Yes, this is precisely where truly strategic tax planning around QBI can make a real difference. If an individual partner owns interest in multiple trades or businesses, either directly or through partnership's core, they may be able to use to aggregate two or more of those businesses into a single larger trade or business solely for calculating their QBI deduction.
Aggregating separate businesses into one for the QBI calculation.
Exactly. This aggregation election is made at the partner level. However, the partnership can perform the aggregation itself and report the combined QBI information to the partners, which simplifies things, but the ultimate decision and responsibility rests with the partner.
What are the conditions for being allowed to aggregate businesses?
Several conditions must be met. First, the same person or group of persons must own 50% or more of each trade or business being aggregated for the majority of the tax year. Second, all the aggregated businesses must generally use the same tax year end. Third, and crucially, none of the businesses being aggregated can be an SSTB. You can't aggregate an SSTB with a non-SSTB.
No SSTBs in the group. Okay. Any other factors?
Yes. Additionally, the businesses being aggregated must satisfy at least 2 out of 3 specific relationship factors. They provide products, property, or services that are the same or customarily offered together. They share facilities or significant centralized business elements, like personnel, accounting, IT, or they are operated in coordination with or reliance upon one another. Basically, they need to be integrated or related in some meaningful way.
Okay, so there has to be a real connection. And why would a partner want to aggregate? What's the specific benefit? How does it save taxes?
The benefit of aggregation comes into play primarily because the QBI deduction for taxpayers above certain income thresholds can also be limited by either 50% of the W-2 wages paid by the business or 25% of W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition UBIA of qualified property used in the business.
Ah, the wage and property basis limitation.
Exactly. By aggregating multiple businesses, you get to combine their W-2 wages and their UPIA of qualified property when applying these limitations. This can allow partners to meet the thresholds more easily across the combined businesses.
So maybe one business has low wages but high property basis, and another has high wages but low basis.
Precisely. Aggregating them allows you to use the combined wages and basis for the limitation calculation for the combined QBI. This often results in qualifying for a much larger QBI deduction than if each business were treated separately and potentially limited on its own. It's a strategic pathway to overcome those limitations and significantly maximize the overall QBI deduction, directly lowering the partner's taxable income.
That's a powerful strategy for eligible partners with multiple related businesses to leverage. And finally, how is all this crucial QBI information, the income, the wages, the property basis, the SSTB status, any aggregation the partnership did reported to partners?
The partnership bears the critical responsibility of providing all this necessary QBI information to its partners. This is primarily done on Schedule K1, typically in Box 20, using a series of specific codes starting with Code Z.
Code Z in Box 20.
Right. The partnership must provide detailed statements attached to the K1 that separately state all the qualified items of income, gain, deduction, and loss, as well as the partner's share of W-2 wages and UBIA of qualified property for each separate trade or business the partnership conducts. Furthermore, as we mentioned, it must clearly identify if any of its trades or businesses are SSTBs, or if the partnership itself has elected to report an aggregated group. This detailed reporting is essential to ensure each partner has the precise data they need to accurately calculate their individual QBI deduction on their personal tax return.
It really highlights the importance of accurate and detailed K1s from the partnership. Okay, this is great. Let's move to our final segment, segment 6. Other important disclosures and financial reporting that show up on Schedules K and K1 or elsewhere. We'll start with tax-exempt income, and the Paycheck Protection Program loan forgiveness is a compelling recent example. How does that work?
Indeed. Tax-exempt income, such as the income resulting from the forgiveness of a Paycheck Protection Program or PPP loan, is handled in a specific way on the partnership return. It is included as an informational item on Schedule K, Line 18A, tax-exempt interest income, and potentially Line 18C, other tax-exempt income.
Okay, reported on Schedule K.
And then it's passed through on Schedule K1, Box 18, Code B or C, showing each partner their share of this tax-exempt income. The important point here for partners is that this income, despite being received and reported by the partnership, is generally tax-free to them at the federal level. It does not increase their individual taxable income.
So even though it's income, it doesn't add to the partner's tax burden a true benefit from that program.
Exactly. And the IRS issued specific guidance, Revenue Procedure 2021-48, clarifying that partners also get to increase their outside basis in the partnership by their share of this tax-exempt income, which is also beneficial, potentially allowing them to deduct more losses or have less gain on a future sale. The partnership needs to report this correctly following that guidance.
Good points. What about unrecaptured Section 1250 gain? That sounds specific.
It is. This type of gain arises from the sale or disposition of depreciable real property used in a trade or business, like buildings, that is subject to depreciation recapture rules under Section 1250. It can also flow through from the sale of certain partnership interests or from investments in other pass-through entities like REITs.
And why is it reported separately?
It's crucial because this specific type of long-term capital gain is subject to a potentially higher maximum tax rate for individual partners, up to 25%, compared to the typical 15% or 20% maximum rates for most other long-term capital gains.
Ah, the 25% rate.
Right. So it needs to be separately stated on Schedule K, line 9C, and then passed through on Schedule K1, box 9C, so partners can correctly apply the special tax rates on their individual returns using Schedule D in Form 1040.
Got it. And self-employment earnings on Schedule K, line 14, and K1, box 14. How does that generally work for partners, and is there a key exception that saves tax?
Generally, a partner's share of the partnership's ordinary business income, from Schedule K, line 1, is considered net earnings from self-employment, NESE. This applies to general partners and often to LLC members who are active in the business. This income, reported in Box 14, Code A of the K1, flows to the partner Schedule SE, Form 1040, and is subject to self-employment tax for Social Security and Medicare purposes. Guaranteed payments for services are also usually NESE.
Okay, so most active partners pay SE tax on their share of profits, but the exception.
The key exception, and this can be a major tax saver, applies to limited partners. Generally, under Section 1402(a)(13), a limited partner's distributive share of partnership income is not included in net earnings from self-employment.
Not included at all.
Generally not. The only exception for a limited partner is guaranteed payments they receive for services they actually rendered to or on behalf of the partnership. Those guaranteed payments are net SE, but their passive share of the partnership's profits typically is not.
So being classified as a limited partner has a big SE tax advantage.
It can, yes. This is a critical distinction that can significantly reduce a limited partner's self-employment tax liability, as their distributive share of profits from the partnership won't be subject to the roughly 15.3% SE tax. Now, the definition of who qualifies as a limited partner for this purpose, especially in the context of LLCs, can be complex and is sometimes litigated, but it's a major planning area.
That's a huge potential saving for those who qualify. What about alternative minimum tax or AMT items? Do partnerships report those?
Yes, Schedule K, line 17, and Schedule K1, box 17, are where the partnership reports items that are adjustments or tax preference items needed for partners to calculate their individual alternative minimum tax on Form 6251.
What kinds of items?
This includes things like certain adjustments related to depreciation, especially on property placed in service before 1987, adjusted gains or losses from certain asset sales that differ for AMT, depletion preferences, and certain intangible drilling costs. These items are crucial because the AMT system recalculates income using different rules, and partners need this K1 information to figure out if they owe the AMT, which can significantly increase a taxpayer's overall tax burden if it applies.
So, more detail needed for potential AMT calculations, and what other credits or potential recaptures might a partnership need to disclose on K and K1?
Partnerships must report various credits that flow through directly to partners who then claim them on their own returns. Examples include the low-income housing credit under Section 42, reported in Box 15, Codes AF, the investment credit, Form 3468 information, Box 15, Codes KP, Work Opportunity Credit, and others.
And recaptures.
They also need to report information necessary for partners to calculate the recapture of certain credits or deductions if circumstances change. For example, if property for which a Section 179 deduction was claimed by the partnership, allowing immediate expensing of the cost, has its business use drop below 50% before the end of its recovery period, a portion of that deduction must be recaptured as ordinary income by the partners. The K1 provides the info needed for the partner to calculate this on Form 4797. So, tracking past benefits is important. Absolutely. Similarly, there can be recapture of the investment tax credit, reported via Form 4255 info on K1, Box 20, Code J, or the low-income housing credit. Partnerships also report information related to fuel tax credits, Box 15, Code G, and qualified rehabilitation expenditures, Box 20, Code D.
Are there any particularly notable new reporting requirements for 2024 that partnerships should be specifically aware of? Anything catching people's attention?
Yes, definitely for 2024, there's the heightened focus on digital assets. This is reflected in a question added to Schedule B, Other Information. Question 27.
Schedule B, question 27. What does it ask?
Partnerships must answer yes or no to the question. At any time during the tax year, did the partnership receive, as a reward, award, or payment for property or services, or sell, exchange, or otherwise dispose of a digital asset?
So, any transaction involving digital assets.
Pretty much any receipt or disposal. This includes receiving crypto as payment, selling crypto, exchanging one type for another, using it to buy goods or services. This highlights the IRS's increasing focus on tracing and ensuring compliance for transactions involving cryptocurrencies and other digital assets like NFTs. It's absolutely vital for partnerships dealing in this area to maintain meticulous records of all transactions, including dates, values, and purpose.
A clear signal from the IRS there. Finally, let's talk briefly about the key financial statements that often accompany Form 1065, usually at the end. Schedules L, M1, and M2. What are their purposes and what insights do they provide?
Right. Schedule L is the balance sheet. It's generally required for most partnerships unless they meet a small partnership exception. It provides a snapshot of the partnership's financial position, its assets, liabilities, and partners' capital at both the beginning and the end of the tax year, reported on a specific basis, like JAP, tax basis, or Section 74B book basis, depending on the partnership situation.
Standard balance sheet info. Any key points?
Yes, it's crucial that assets cannot be netted against liabilities on Schedule L, and all reported asset amounts must be non-negative. It gives a picture of the entity's financial health.
Okay. And Schedule M1, the reconciliation.
Schedule M1, the reconciliation of income loss per books with income loss per return, is incredibly important for transparency and accuracy. It reconciles any differences between the partnership's financial statement net income or loss, what's recorded on its accounting books, and its taxable income or loss reported on Form 1065, page 1, line 22, or Schedule K, analysis of net income loss, line 1.
Why are there differences?
Differences arise all the time due to book tax, differences in timing, or permanence. For example, meals might be 100% expense on the books, but only 50% deductible for tax. Tax-exempt income is included in book income, but not tax income. Depreciation methods might differ. Schedule M1 explains these differences, helping ensure consistency and providing a clear audit trail for the IRS.
Makes sense. And Schedule M2, the analysis of partners' capital accounts.
Schedule M2 provides a detailed roll-forward analysis of what caused the changes in the partner's aggregate capital accounts throughout the year, using the same basis reported on Schedule L, often tax basis now. It starts with the beginning balance, adds contributions, adds net income per books from M1, adds other increases, subtracts distributions, subtracts losses per books, subtracts other decreases to arrive at the ending capital account balance, which should tie back to Schedule L.
So it shows how partner equity changed overall.
Exactly. These three schedules, L, M1, and M2, collectively provide a comprehensive financial picture of the partnership, showing its financial position, reconciling book and tax income, and detailing the changes in partner equity throughout the year.
Is there an exception for smaller partnerships regarding these potentially complex financial statements? Filing all that seems like a lot.
Thankfully, yes. There is a specific small partnership exception that can alleviate this burden. Schedules L, M1, and M2 are optional if the partnership answers yes to all parts of Schedule B, question 4.
Schedule B, question 4. What are the criteria there?
Generally, this applies if the partnership's total receipts for the tax year were less than $250,000, and the partnership's total assets reported on Schedule L at the end of the tax year were less than $1 million. And Schedule K-1s are filed with the return and furnished to partners on time. If all those conditions are met, the partnership doesn't have to complete Schedules L, M1, and M2.
That's a significant simplification.
It is. It significantly simplifies the filing burden for eligible smaller entities, recognizing that the complexity of preparing and reconciling these detailed financial schedules might be disproportionate to their size and complexity.
Looking at all this detail we've covered, it truly underscores the value of understanding these instructions and identifying those efficiencies we've talked about. Do we have any statistics on the average time and cost burden for just filing Form 1065? What does the IRS estimate?
We do. The IRS provides these taxpayer burden statistics annually in the instructions. For all partnerships filing Form 1065 and related attachments, the average burden is estimated to be around 60 hours.
60 hours.
Yes, and approximately $5,000 in average costs. This estimate encompasses record-keeping time, time spent learning about the law or the form, preparing the form itself, and copying, assembling, and sending the form to the IRS.
Wow. And for smaller partnerships, is it much less?
For small partnerships, specifically defined for this statistic as those with end-of-year assets less than $10 million, the average burden is slightly lower, but still substantial. It comes in at about 50 hours and $3,100 in average costs.
50 hours and over $3,000, even for a relatively small partnership. That really puts into perspective how vital it is to navigate these forms efficiently and strategically.
It absolutely does. These numbers aren't trivial. They reinforce why a thorough understanding of these forms and instructions isn't just about basic compliance. It's about proactively managing your partnership's tax position, identifying those genuine tax-saving opportunities we discussed, like the QJV election, the small business exceptions for UNICAP and B limits, the Section 754 election benefits, grouping activities, maximizing QBI, and ultimately safeguarding your financial resources by avoiding unnecessary costs and complexities.
So to quickly recap this extensive deep dive into the 2024 Form 1065, we started with the basics, the IRS definition of a partnership, who must file, getting the crucial identification details right on page 1, and vital operational information like record keeping and filing procedures.
Right. Then we explored how understanding the income and deduction lines on page 1, especially things like guaranteed payments for partners, including health insurance, and those powerful small business taxpayer exceptions for the business interest expense limitation and the uniform capitalization rules, can directly lead to significant tax efficiencies and better cash flow.
We also decoded the absolutely critical schedules K and K1, highlighting how they pass through the partnership's tax items and how partnership elections like the qualified joint venture for spouses, the profound impact of Section 754 basis adjustments for buyers or inheritors, and the ability to elect out of the centralized audit regime directly impact the individual partner's tax situations and liabilities.
And we dove deep into activity classification, passive versus non-passive, the rental exceptions, the strategic grouping of activities to utilize losses, and of course, the qualified business income deduction. We covered what QBI is, the SSTB limitations, and the powerful aggregation opportunities partners can use to maximize that 20% deduction, alongside how the partnership reports all this crucial info on the K1.
We finished by touching on other key disclosures like tax-exempt PPP income, unrecaptured 1250 gain, the critical self-employment tax rules for limited versus general partners, AMT items, credits, and the new digital asset question, plus the financial statements L, M1, and M2, and the small partnership exception.
It's a lot, but hopefully clarifies the landscape.
This deep dive truly shows that navigating Form 1065 isn't merely about meeting a deadline or ticking boxes on a form. It's about proactively managing your partnership's tax position, understanding the nuances hidden in those instructions, and ensuring you're taking advantage of every legitimate opportunity to optimize your financial outcomes and build a more robust financial future for the partnership and its partners.
And this really raises an important question for you, the listener, to think about. The IRS instructions for Form 1065, while undeniably dense and complex, contain the very blueprints for significant financial health and tax efficiency for partnerships. When you know how to read them or work with someone who does, you're not just filling out a form, you're actively shaping your financial future.
That's a great way to put it.
So the thought is, what other dense instructions or complex documents in your business or personal life might hold similar hidden opportunities for growth, savings, or efficiency if you took the time to truly understand them, rather than just seeing them as a compliance chore?
A perfect provocative thought to leave you with. Remember, while we've unpacked a tremendous amount of information today, tax law is incredibly complex and constantly evolving. Always, always consult with a qualified tax professional for personalized advice tailored to your specific partnership situation and your individual circumstances.
Absolutely essential.
Thank you so much for joining us for this deep dive into the 2024 Form 1065. We hope you feel more informed and empowered to tackle it.